Uh, what's up, everybody? This is Sunko, the Korean bro. Today is 2022, November 10th. Time flies indeed, and we only have a month left before next year. So, what do we have tonight? A lot of things happened today and last night. What we know is that we had like 13% drop from Bitcoin. My friend has lost a lot of money from that downward trend. And let's see what else we have. Let's go to economic calendar. Molly Full, Yahoo Finance, and lastly, marketbeat.com. Hmm. First, what I'm gonna do is go to economic calendar and see uh what event we have. Okay. United States, uh, Eurozone, China. Uh-huh. Okay. Today is November 10th, and we have a lot of things tonight. Initial jobless claims. It's way bigger than forecasted. CPI is lower than forecasted. Let's see what that indicates. Okay, CPI, initial jobless claims. The consumer price index measures the changes in the price of goods and services from the perspective of the consumer. It is a key way to measure changes in purchasing trends and inflation. A higher than expected reading should be taken as positive and bullish for USD. A higher than expected reading should be taken as positive for USD. So we have lower than expected reading should be taken as negative. So we have a lower 7.7%, which is lower than 8.0%. And what else we have? U.S. initial jobless claims. Initial jobless claims measures the number of individuals who filed for unemployment insurance for the first time during the past week. This is the earliest U.S. economic data, but the market impact varies from week to week. A higher than expected reading should be taken as negative, bearish for USD. And what we have is a 225K, which is higher than forecasted amount. And what that indicates is the negative, yeah, negative indeed. Uh, if you think about it, um, people uh who file for unemployment is much higher, right? It indicates something is not good, right? 225, obviously, the number itself is higher than 220, so it's not good for economic development, obviously, right? Because the more people work, uh, the better economy we can expect. Mm. So condition of U.S. is not so good. Well, it's not just only U.S. but also like worldwide. Let's go to Motley Fool. Rivian says demand remains strong. Should you buy the deep? The trade dash makes its largest market shares gains ever. Is the stock buy? Affiliation says it might be launching as supported tiers at exact wrong time. Is Meta stock a buy after falling more than 70%? Interesting article. To launch in a decade buying opportunity to notch the bear market. Social security is a big issue in the States too. Three LED dividend stocks down 13.5%. One electric vehicle stock to buy hand or fist, and two with serious red flags. Okay. Notch the bear market. Three phenomenal bargains. They can double your money by 2027. Three growth stocks to buy what $1,000 right now. Two dividend stocks double up on right now. Okay, let's see. First, Rivian says demand remains strong. Should you buy the deep? Rivian, electric vehicle company. My company also provides some system for Rivian because in auto like vehicle factory, there's gotta be a lot of systems, and among the systems, our system can also be used. Uh, anyway, anyway, even as Rivian delivers more vehicles, its pre-order level is rising quickly. Okay, the company has slowed some spending to focus on ramping production. Okay, the valuation remains high, but recent stock deep has made it more compelling. Let's look at the price chart of Rivian. Okay. Hmm. Current price is 28.7. Its all-time high was 146. Okay, should you buy the deep right now? Okay. Rivian stock still isn't cheap even after recent 20% drop. Isn't still cheap, okay, it's author's opinion. But the business progress seems to be checking the right boxes. Investing in the electric vehicle industry is risky, as it means exposure to unproven businesses in the nascent industry, valuations based on promise and potential add to the uncertainty for investors' returns. But the basics of supply and demand remain the foundation for investments. Okay. Rivian Automotive reported its third quarter update Wednesday after the market closed, and it seems both supply and demand remain on a positive track. The stock has dropped nearly 20% over the last 2 weeks, so it's worth digging in to see if the report supports its being a good time to buy that deep. Standing out among peers. It was a good time for Rivian to share the demand for its R1 platform trucks in the form of pre-orders increased by more than 16% from the end of June to November 7th, 2022. Hmm. So what's the bottom line here? Keep an eye out. Investors should be aware, however, that Rivian has also announced plans for a joint venture with the Mercedes-Benz Group, van division in Europe. The company may need to raise capital or borrow from its revolving credit facility for that venture, depending on future timing. Additionally, supply chain headwinds haven't completely receded. Those constraints are what forced Rivian's vehicle production target for this year to be lower to the current 25,000 unit level. but the company seems to be managing that as well as rising cost challenges. It has lowered its capital spending guidance for this year to focus on increasing production and pushing back some spending into 2023. That resulted in moving the anticipated launch of its R2 platform back 1 year to 2026. That seems to be prudent of management in the current economic environment. However, but these are things investors must continue to monitor. Also, of concern is that while its progress seems positive and the stock has dropped 20% recently, Rivian's valuation is still high. Investors expect great things from this company. Its market cap remains about $25 billion. If one project the third quarter sales out for a full year, Rivian's price sales ratio remains high at about 12. So, in general, author's opinion is that if you look at the long term, you'd have to wait a long period for you to um, get some profit. But this quarterly result looks promising, so he expects to have a good result soon. Mm. But for sure, we have a lot of headwinds and we have supply issues. Still, it's something that this company has to solve. So we have a lot of things to figure out. So I'm not gonna invest in Rivian yet. I'm just gonna look into it. Hmm. The trade desk makes its largest market share gains ever. Is the stock a buy? Okay. The trade desk. Okay. Let's see. Let's look at price level of trade desk. Mm, Current price is 39.89. Okay. The most recent quarter, the trade desk grew revenue faster than its peers, highlighting its market share gains. The company's operating expenses are soaring, which could hurt its profitability if the advertising slowdown finally affect its business. Long term, its leadership position in the space suggests it can grow its top line substantially the coming decade. So, litter wise, they're doing very good. Um, Operating expenses are soaring, so it could possibly hurt their profitability. Its revenue grew faster than ever, which is a good sign. Hmm. Okay, let's keep on reading it. The trade desk is impressively growing at scale despite adverse economic conditions. I forgot what they do. So, Trade Desk operates as a technology company in the United States and internationally. The company operates a self-service cloud-based platform that allows buyers to create, manage, and optimize data-driven digital advertising campaigns across various ad formats and channels, including display, video, audio, native, and social on various devices, such as computers, mobile devices, and connected TV. It also provides data and other value-added service. The company serves advertising agencies and other service providers for advertisers. The Trade Desk Inc. was incorporated in 2009 and is headquartered in Ventura, California. Okay. So mainly what they do is uh, self-service cloud-based platform. Self-service cloud-based platform. So they provide cloud service and user can use cloud service to manage data driven advertising campaigns. Data driven advertising campaigns. Okay. Demand side advertising platform. It's advertising platform to put it simple. Demand advertising platform, the Trade Desk reported financial results for the third quarter of 2022 on Wednesday morning, and managed to buck a troubling trend. While most advertisers are struggling with the looming possibility of a global recession, the Trade Desk is growing at a healthy clip. So, the word that I can that I have to focus on is data driven advertising company. Okay, so anyway, unlike other advertising companies, they're doing very well, right? Which is really good. Uh, they got competitive edge, right? In the conference call with an analyst to discuss quarter three results, founder and CEO Jeff Green said, "I believe that through the first 9 months of the year, we have gained more market share than at any point in our history." Mm. And that's a big statement worth examining. Gaining market share in the ad space. Okay, the Trade Desk went public 6 years ago and has crushed the S&P 500. During this time, it's up over 1,300%. Moreover, the company was only founded in 2009, yet it has already scaled to nearly $1.5 billion in trailing 12-month revenue. Simply put, it entered the ad space and quickly took market share. So they are growing so fast. That's the point. Okay. In quarter three, the Trade Desk generated revenue of $395 million, up 31% year over year. To be clear, this was a marked deceleration in growth, as first quarter revenue was up 43% year over year, and second quarter revenue was up 35%. Perhaps more troubling for some investors was the Trade Desk fourth quarter guidance. Management is guiding for quarter fourth revenue of at least $490 million, which would be an increase of only 24% from the fourth quarter of 2021. Here's the thing, while the growth rate is slowing, the company's market share gains, while the overall industry slows, are more meaningful. The growth rate is slowing, the company's market share gains. Consider that according to recent survey by the World Federation of Advertisers, 40% of companies are just maintaining their market budgets for 2023, not increasing them. Another 29% are lowering their budgets, and 75% say they are scrutinizing their spending. So is this stock a buy? Yeah, indeed. Gaining market share during adverse economic conditions is a testament to the strength of the Trade Desk business. It serves as a solid foundation for a long-term investment thesis. Yes, indeed. A simple explanation for why the stock can go up. There's more to building a thesis than this, okay? There are potential risks involved in an investment in the Trade Desk. First, the company is involved in programmatic advertising, which allows brands to quickly change their advertising strategies. Yeah, however, its performance so far in 2022 and in quarter three specifically demonstrate that the trade desk is a leader in the digital ad space. And as a leader, it might be expected to continue capturing a larger share of a market. The company estimate is worth a massive at $816 billion. There is risk to any investment, but beyond near-term macroeconomic uncertainty, the trade desk is stock worth owning for the coming decade. Okay. Okay. Hmm. I already knew that it's got a lot of potential. Uh, I myself also invested some of money into it. Okay, let's go to Netflix and Disney. Netflix and Disney might be launching ad-supported tiers at the exact wrong time. Huh. Ad sales are getting more competitive and declining across the board. Ad sales are getting more competitive, okay? The outlook for the fourth quarter isn't great. That could result in lower than expected revenue from the ad-supported tiers of Netflix and Disney Plus. Ad sales are falling off. Hmm. So, this author also says outlook for digital advertising is not so good. It shows a bleak outlook. Oh, okay. And what that means for streamers, the ad supported tier on streaming services not like Netflix and Disney Plus might not generate as much revenue as expected to start. Okay. Is Meta stock a buy after falling more than 70%? Let's look at Meta. Wow, wow, wow. All time high was 347. It's now 105. Meta's advertising business is facing enormous challenges going forward. The metaverse remains a moonshot adventure, and Meta stock is trading at a historically low valuation. Okay, Meta might be down, but it's not out for now. Okay, it's uncommon for large companies with more than $10 billion in market capitalization to lose more than 70% of their value in a year. Wow. What happened to Meta Platform in the last 12 months was almost unprecedented. It lost more than $700 billion in market cap. Bargain hunters are getting excited. But is it the right time to buy the stock now? Let's dig further. Hmm. Wow, 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 wow. So 106. This is a price level. Uh, this price level is the same as the one we had a decade ago. Hmm. So bargain hunters can be excited, right? Meta's advertising business is struggling. Okay. When Meta reported a 1% decline in operating income for the fourth quarter of 2021, everyone was shocked. But such poor performance was alien to a company accustomed to delivering solid performance over the years. But as Meta reported its performance in the subsequent 3 quarters, investors became horrified by what they saw. Worldwide operating income fell 25%, 32%, and 46% in the first, second, and third quarters, respectively, of 2022. Declining revenue and growing expense contributed to the lower operating income. Once the backlog of Meta's business, the advertising segment got hit hard by the challenging economy. Competition from short form video companies and ad signal loss due to the change in Apple's iOS policy. Financially, the advertising segment delivered progressively lower income every quarter in 2022, from $11.5 billion in the first quarter to $9.3 billion in the third quarter. Hmm. Okay, there are good things and bad things. Of course, there um metaverse business metaverse business uh, is not so doing good, but there are other business that they're doing, um, which is delivering some of apps like Facebook Messenger, WhatsApp, and Instagram. They're doing pretty good, I guess. Improved engagement levels, okay, in the third quarter of 2022. Mm. Daily active users growing, okay. Mm. Meta is working to turn its advertising business around via Reels, investing in artificial intelligence, improving monetization. So is it a buy? Let's go to bottom line straight, okay? Investors were cheering for Meta's solid performance amid the pandemic 2 years ago. Today, investors are pessimistic about Meta's prospects as it faces the above mentioned challenges. It does not help that the investment in the metaverse is consuming cash rapidly, even as the advertising business profitability is declining quickly. A declining cash cow and cash consuming unproven venture do not look attractive to investors. Okay. So I think the advertising business may have reached its prime, but is far from out of the game. It still hosts 3.7 billion MAU across its social media apps and generates billions in profits. $9.3 billion in the latest quarter. Besides, Meta is banking on Reels to retain user engagement in the coming months. While it may be difficult, even imprudent, to convince new investors to buy Meta stock, exciting investors may want to give the management team some time to turn the ship around. At least give it a few quarters more before making the next move. So, authors thinks that advertising business um, reached its prime, but it's far from out of the game. So it still generates a lot of money, and it's obviously a big industry where you can get a lot of profit. So, uh, but should you buy Meta right now? People are pessimistic, but still, it's big. So choice is yours. I think that's author's opinion. To once in a decade buying opportunity, not the bear market. So what are these? Google, Nvidia, Alphabet. Okay, I've seen many times. Let's look at price level of Nvidia. Nvidia. Mm, Very good price level indeed. 147. I'm just gonna wait till next month because we have another interest rate hike next month. So we'll see. Nasdaq bear market, three phenomenal bargains. They can double your money by 2027. So what are these? Baidu. Okay, what else do we have? Novavax, Fever International. Let's read Fever International again. I've read it multiple times, but it's one of the company that I invested into, so I paid attention to it. Okay. The third phenomenal bargain, they can double your money by 2027, is online services marketplace Fever International. Keeping with the theme of this list, Fever has taken its shareholders on quite the roller coaster ride. In 3 years, shares of the company have moved from the mid 20s to more than 300 and back to the mid 20s again. Skeptics appear to be concerned with growing likelihood of a US recession and how that might adversely impact a business based on freelance remote work. Mm. Although recessions are an inevitable part of the economic cycle, they tend to be substantially shorter events than bull markets and periods of economic expansion. Yes. To add to this point, the dynamics of the labor market have been permanently changed by the pandemic. Though some workers have returned to the office, the percentage of the employees working part time or full time from their homes or remotely has grown significantly. This puts Fever's freelancer marketplace at the center of the remote work trend. So, uh, pandemic is still going on, and it's been with us for past 2 years. And during this pandemic era, things have changed a lot. Especially working trend has changed. A lot of people instead of working at home, instead of working inside the office, they work at home, and this working trend um, mm, has been more flexible. Uh, so because of that trend, it could boost sales of Fevers International. Fevers, what is it? Fever International company. Mm. And this trend will go on, even if a pandemic era disappears. The other significant advantage, as I've touched on before, is Fever's superior take rate. How much the company gets to keep from each deal negotiated on its platform. With most online service marketplaces dealing with take rates in the road to mid teens, Fever reported a take rate of 29.8% in the June ended quarter. So unlike other online services, they get more profit. So here it says reported a take rate of 29%. Okay. Mm. Given Fever's sustained competitive advantage and double-digit growth rate, its floor price earnings ratio of 25 looks like a show for opportunistic investors. Mm. It's what I read before, but Fever, I feel like I have to use it myself to check it again. On a more company specific basis, Fever brings clearly identifiable competitive advantage to the table. Instead of having freelancers price their tasks on a per hour basis, like virtually all of its competitors, Fever's freelancers lease their tasks as a package deal. This greatly enhances cost transparency, which has been a powerful tool to keep spending per buyer climbing. Mm. So they got two advantage: superior take rate and instead of uh taking taking instead of having tasks on a per hour basis, uh their task is a package deal. Mm, okay. Okay, next one. 3 reasons 2023 could be a big year for Bitcoin. Okay, let's see. One survey indicated that 74% of institutional investors plan to invest in Bitcoin at some point in the future. 74%. Okay. Top financial firms and tech companies, including Alphabet and MasterCard, are getting more involved in crypto. Okay. An eventual slowdown in interest rate hikes from the Federal Reserve could be a boon for Bitcoin. Mm. So he's really positive in terms of trading, in terms of investing some of money into Bitcoin. Although a lot of investors has had a hard time throughout 2022, but in 2023, things are going to get better. It's his opinion. We'll see. Hmm. Three growth stocks to buy with $1,000 right now. Cloudflare's traffic results, solid outlook point toward better times ahead. Cloudflare. Let's look at Cloudflare first. Cloudflare. Wow. It went up 14% today. Wow. Hmm. Okay. Cloudflare. So what they do is security, to put it simple. Security. Hmm. Security um cloud service. Okay. Shares of internet infrastructure and security provider Cloudflare were in a doghouse on November 4th. The stock fell over 18% in a day despite releasing terrific third quarter results that crushed Wall Street's estimate the day before. In this uncertain economic environment, even the idea that growth might be slowing was enough to spook investors and sink the stock. Mm. The company's revenue shot up 47% year over year. Mm. To $254 million, while adjusted earnings increased to 0.06 per share from $0 in the prior year period. Analysts would have settled for $250 million in revenue and break-even earnings per share. But healthy growth in Cloudflare's customer base and increase in customer spending helped it ease past consensus estimates. Hmm. Okay. Uh, ha, 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 ha. Wow, we have 11% up from Appelt Interactive. Hmm. Wow, 21% from Unity Software. Okay. Slightly more Americans applied for jobless benefits last week. Slightly more, yes. Charles Schwab is making all the right moves. U.S. stock futures jump after report shows inflation cooling. U.S. consumer inflation eased to 7.7% over past 12 months. Falling valuations drive stock prices down to earth. Okay, slightly more Americans applied for jobless benefits last week. The number of Americans applying for jobless benefits rose slightly last week, but the labor market remains healthy despite job cuts that have begun to spread across industries most affected by soaring interest rates, such as housing and technology. Unemployment climbs for a week ending November 5th, rose by 7,000 to 225,000 from a 218,000 the previous week. The Labor Department reported Thursday the 4-week moving average declined by 250 to 218,750. Applications for jobless claims, which generally track layoffs, have remained historically low this year. Even as the Federal Reserve has cranked up its benchmark borrowing rate 6 times in its effort to cool the economy and tame inflation. Okay, it has remained historically low this year. So the number shown on the economic calendar was not that high because he says it's remained historically low this year. A strong job market is deepening. The challenges the Federal Reserve faces as it raises interest rates at the fastest pace since the 1980s to try to bring inflation down from near a 40-year high. Steady hiring, solid pay growth, and low unemployment have been good for workers. Hmm. Okay. So overall, what author is trying to say is, mm, uh, although we have slightly more America apply for jobless benefits last week, um, it's not as bad as it looks. Oh, and but the labor market remains healthy despite job cuts. Okay. Charles Schwab is making all the right moves. Uh, What is this company? Schwab? Let's just give it. It doesn't look that important. U.S. stock futures jump after report shows inflation cooling. Wow, inflation cooling. There's a sign. We'll see. Acceleration is sweeping through Wall Street and financial markets worldwide. Thursday, after reports showed that inflation in the United States slowed last month by even more than expected. Futures for U.S. stocks are surging 2.5% or more, indicating a big increase once trading begins, while prices jump immediately for everything from gold to crude oil to stocks in Europe. Even Bitcoin clawed back some of its steep plunge from prior days caused by the crypto industry's latest crisis of confidence. The most dramatic action may be happening in the bond market, where Treasury yields sank sharply as investors paired bets for how aggressive the Federal Reserve will be in hiking interest rates to get inflation under control. Those big rates hiked by the Fed have been the main reason for Wall Street struggles this year and are threatening a recession. The yield on the 10-year Treasury, which helps set rate for mortgage and other loans, fell sharply to 3.93% from 4.10% late Wednesday. Slower inflation could keep the Fed off the most aggressive path in rising interest rates. It's already raised its key lending rate to a range of 3.75 to 4%, up from a close to zero in March. But it's not scary high, okay? Hmm, something we have to look at, right? US consumer inflation eased to 7.7% over the past 12 months, okay? Price increases moderated in the United States last month in the latest sign that the inflation pressures that have gripped the nation might be easing as the economy slows and consumers grows more cautious. Consumer inflation reached 7.7% in October from a year earlier and 0.4% from a September. The government said Thursday the year-over-year increase slowed down from an 8.2% in September, was smallest rise since January. A separate measure called core inflation, which excludes volatile food and energy costs, rose 6.3% in the past 12 months and 0.3% from September. The numbers were all lower than economists had expected, helping drive the inflation slow down from September to October, where used car prices was dropped for a fourth straight month. So a lot of goods, the price of a lot of goods dropped. Here it says also downward the prices of clothing and medical care. Food price increases slowed. Okay, many economists have warned that in continuing to tighten credit, the central bank is likely to cause a recession by next year. So far this year, the Fed has raised its benchmark interest rate six times in sizable increments, heightening the risk that prohibitively high borrowing rates. Anyway, we're seeing a good sign. Okay. Okay, this is it for today, and I'm gonna see you tomorrow, okay? Bye bye.